It's official. The cash rate has changed. 12th of August, yesterday.
So as you know, today the board decided to cut the cash rate by 25 basis points.
But what does this actually mean for us as property investors?
And this does have a ripple effect to borrowing power, but also savings too.
This episode, we speak to property investor and mortgage broker Morgan Bushell to unpack what does this change actually translate to in terms of dollars for us?
It's basically double with $1 million loan.
How could this actually affect the property market?
As rates go down, it creates that kind of Jaws effect, but then it also catches the attention of the general population.
As well as potentially, most excitingly, the increase of borrowing power for almost all of Australia.
If we get 25, then you're looking at a borrowing capacity of...
If you thought the game of property investing was over when rates started going up, maybe thought I'll never get into the market, the downward trend we seem to be on should be very exciting for you. And it's time to learn more about it. My name's Todd Sloan. This is the Pizza and Property Podcast. And this episode is powered by Investor Kit, Full Circle Finance, and Property Strats. More about our awesome show sponsors in the show notes below. But right now, let's jump straight into this episode with Morgan Bushell. Morgan Bushell, time to talk rate cuts, man. You excited?
Yeah, let's go, Todd.
I'm a little bit disappointed every time that I don't see Michelle Bullock come out with a confetti cannon. Like I think it's appropriate.
Look, for property investors, it's very appropriate. So maybe we can wait and see. Maybe it'll happen.
Okay. Maybe if we send one to our office and just cross our fingers.
Courtesy Pizza and Property and all property investors of Australia.
And just mortgage holders in general.
Yeah, that too, yeah.
But it's time to celebrate a little bit because we've had a change in rates. So they've come down 25 basis points.
Yep.
What's your thoughts?
Yeah, so every little bit counts. And this is something that's just going to move that dial a little bit more for property investors.
And you're right, like it's a little bit, but I mean, as we're about to go into the numbers, the little bits kind of add up to a lot when you're talking like the savings per month, then adding up over the year.
Exactly.
So we're talking a bit of a saving. Why don't we actually put this saving in perspective, like into dollars? And let's not just talk about the change that's happened. Why don't we actually do this in a way of like a few different changes? Because by the way things are looking right now, it's not looking like this is going to be the last rate cut, and like it's a bit of a watch this space. So can we break this down from $500,000 loan to begin with and then also look at $1 million?
Yep, let's do it. So let's work through a few scenarios here. So if we start with, say, a 10 basis point decrease, this roughly equates to about a $41 saving per month.
Okay, so not shooting the lights out, but...
No, but I mean, look, at the end of the day, you're saving some money.
Yeah, it's a couple extra Macca's meals a month.
Yeah, like maybe one lobster. So
one lobster? Where do you get lobster?
A tiny one.
I think they call that a yabby. All right, what if we go like 25 basis points?
Yeah, so if we get 25, savings is a bit bigger. You're going to save about $104 on a $500K loan.
Okay, so it's starting to be a little bit of something. And a $500K loan as well. So we're still talking like reasonable debt, but not large portfolio debt.
Exactly, yes.
Yep. Okay, and what about full 0.5%?
Yeah, so if we go full 0.5%, that's where it basically doubles. So you'll save $208.
$208. All right. And so if we're looking at $208 per month, so $50 a week. So as far as cash flow improving, this is making a difference.
Yeah, it's a big step change, like either 10 versus say 50. That's a big amount once you extrapolate that over a year as well.
And later on, I actually want to start unpacking something that you've put together about like basically rents slightly increasing, rates slightly decreasing, and this little equilibrium that you actually find with cash flow. And while some properties right now might be a little bit tricky to hold, but as these two start to meet each other, it's looking like the stars may align, if you will, then things can get much, much more comfortable for portfolio growth. But can we quickly just actually rush through $1 million? Is it literally just double everything that you've said?
More or less, yeah. Like if you were to look at it like that, it's basically double with $1 million loan.
All right, so 0.5%, we're talking $416 a month on $1 million worth of debt. So if you've got a couple of investment properties, this is essentially $100 a week you'd be saving.
Yep.
So whilst an increase in cash flow is good, a small amount, a big amount, obviously bigger is better. But let's start talking about the market, the knock-on effect that this can actually have, because it's not just everyone's like back pocket personally. It's also the borrowing power aspect that this has. Then also knocking onto that, the then inflationary effect that can come with that. When people have more, they can spend more. Can you open this up a little bit more from a historical point of view and how it applies to today?
Yeah, so if we're all to get into our time machines and go back to like 2015, for example, So if we cast our minds back to then,
We'd be doing the Harlem Shake, I think.
yeah, we'd be doing that. Oh my gosh.
I remember that.
Yeah. So apart from shaking, everyone was kind of at that point focusing on buying in the market of Logan.
Mm-hmm.
So back then, like you could kind of achieve properties around the 200K mark. Also at that time, rates were going down, which is what we're kind of in the same sort of environment right now.
Okay, but your comparison here with Logan, 2015, didn't Logan sit pretty stagnant for another 5 years though? It was only around 2020, 2021 that it was like to the moon?
That's right, yeah. It really took after that. But between then, it kind of did nothing.
Okay, and so what's one of the comparables that you're seeing, like a market at the moment that you feel is a lot more affected by interest rates? Because I feel like I know what you're going to say, but I don't want to put words in your mouth.
So the main comparable here is, as property investors, we see the value, whereas someone who's like general population, they'll look at it and go, why are you buying there? Which was the exact same thing that was happening in the Logan market back in 2015.
I don't think I heard anything positive about Logan that whole time.
Yeah.
It was just, the whole why are you buying there rhetoric. And now you and I are pretty close with a couple of people that bought incredibly heavily there, and they have now done incredibly well.
Yeah.
I'd like to have bought more there. But so you're looking at this now as a comparable to where?
I'm looking at this as a comparable to the outer ring of Melbourne, and then some of the more regional centres that will get that flow-on effect, kind of like what we saw with Logan / Ipswich.
Okay, so the parallel that you're drawing is basically like the general population are seeing Melbourne now as like a why would you?
Yeah.
Because of all the negative sentiment. However, there's a few property investors, which you are more than likely one of them listening to this right now, that are kind of looking at Melbourne going, no, I see the opportunity. It's the zig while others are zagging.
Yeah.
But this rate change is then going to be one of the things that could potentially affect that sentiment on the masses level.
Yeah, that's right. And so bringing it back to what you said, like as rates go down or even potentially rent goes up, it creates that kind of Jaws effect, which as investors we want, but then it also catches the attention of the general population.
Koshy starts talking about, well, actually, no, he's not talking anymore, is he? But, it's the general news story then.
That's right. When you see places appearing on general news, it's too late.
Have you started to see that as well, the negative sentiment when you're in Melbourne? I've been spending a lot of time in Melbourne recently. I know you've been spending a bit of time there.
Yeah.
Like, it's just you talk to someone that just lives there. They can't, why are you investing here? What's wrong with you?
Yeah, like friends or like business associates who aren't in the property investing space. I'll ask what is their opinion on some of the markets we all talk about. I can't say I've heard anything positive.
I talked to a plumber the other day that said, I can't afford to invest here. It's just as expensive as Sydney. And I was like, when was the last time you actually looked at realestate.com? I was like, I haven't looked. Just the assumption that it was just all still exactly the same. I'm like, mate, you might want to jump on Domain or realestate.com and have a look at some prices. It's a better opportunity than you think. Yeah, but anyway, not wanting to get into the Melbourne side of things. This is just more so about a market that has historically been more affected by interest rates. Also a market that when there's a sentiment shift in it, like you're describing now, Morgan, a change like we've had yesterday can actually start to affect it. Whilst it might not be massive, again, like we're talking about, this is where it starts compounding. We get a change like this, another change, and it starts to actually go from why are you buying there to, oh, okay, this is starting to make a lot of sense.
Yeah.
But if you're one of those early adopters, naturally, you get more of the growth side of it.
Yep.
But speaking of the growth, though, cash flow, not just Melbourne, in so many places now, it's not what it used to be. Getting like a 7% yield, it's just doable in some places, but it's near on impossible.
Yep.
So most of the time, you're getting 4s and 5s. 5's like super good. Let's talk about this cash flow that you put together as far as rates coming down, rents going up, and sort of finding this little equilibrium here.
So something that I see my bigger clients do as well as what I do is it's looking at the bigger picture. So if I give you an example, let's just say hypothetically you're buying in, say, a market where you're getting a 620 purchase price.
Okay.
And with that scenario, let's just say the loan is 496. So that's
like a 20% deposit.
Yeah.
Yep.
So then interest rate, let's just go off, say 6% for an interest-only loan.
Okay.
We're also going to factor in land tax. So I'm kind of forecasting Victoria again, just in case that comes into the picture.
Okay, so a bit of a worst case scenario.
Worst case. And then we're kind of adopting a lower rent. So about $490 per week on this.
Okay. So what's the yield on that?
So it's about 4.1%.
So not amazing, but pretty standard.
So once we factor in all of these elements, we roughly get about a 237 per week negative cash flow.
Okay, and you're taking like all expenses into account. That's not just like a rent versus mortgage.
Yeah, like we're also building in insurance, like I said, land tax as well.
Yeah,
it's going
council
pretty
rates,
conservative here.
Okay, all right. So 237. Now keep walking me through this, because I think this right now is where so many investors are getting stuck naturally. Looking at this, going, well, if I buy 2 of these, all of a sudden I'm negative by $500 a week. How the hell can I afford to hold 3 or 4 of them? This is looking impossible. Start peeking around the corner though, Morgan.
Yeah. So if we look behind the curtain or peek around the corner, like you said, let's just hold that whole scenario the same.
Yep.
But we change 2 things. Let's reduce the interest rate down to 5%.
Okay.
And at the same time, if rent went up $100 per week, so $590 per week, all of a sudden our negative cash flow actually becomes minus $44 per week.
Which is a lot more harder. Okay, so but now walk me through your 2 variables, just for everyone that's about to start going like, yeah, well, if the interest rate comes down 5%, it'll be nothing. Like, how is this reasonable? How is this an actual peek around the corner that we can go, yeah, this has got merit?
With what we're seeing in the market at the moment, there's obviously a house view that interest rates are going to keep decreasing. But also with the market at the moment, it's quite tight from a rental perspective too. So with these 2 things coming into play, it's quite realistic. Like, I don't know what time frame that is when we'll see this.
So you're not talking about this over the next couple of months. You're talking about this as like a year, 2 years, potentially like a
1 to 2 year strategy. But ultimately, if you can get in now and you can afford to hold, this is where it will pay off later. Because if you get in at that point where it's minus 44 per week, chances are like you would have missed out on a lot of gains.
And this is the whole thing. It's like you were saying before, as soon as it's in the media, it's like it's too late. It's already done. I wonder if we're classified as the media now. I remember I used to hear people go, as soon as you see it in the magazines, like it's done.
Yeah, here we are on a podcast, which is also media.
Yeah. Anyway, my whole point of this though, the thing that I like about the point that you're making though, is so we're going down 1%, which is a lot, let's be honest, but it's looking like that's genuinely possible. And we're going up by $100 a week rent. So if you're currently paying in that situation, what was it, $470, $480?
$490.
$490 a week. So basically rent's going to $590 a week.
Yep.
Rents in Melbourne have been pretty, like, I mean, obviously they've gone up, but otherwise pretty stable. So I know that personally, a lot of the rents in my portfolio, and you'd probably echo the same thing, over the past few years, there was stuff that we were renting out for $350 a week, which is now like $600 a week.
Yeah.
$100 increase over a year to 2 years seems pretty realistic.
Yeah, in some markets, that's pretty standard actually.
So if you're looking at this as the whole peek around the corner, you're essentially saying if you wait until it's actually happened, well, then those are the gains that you've potentially lost. Yep. If, again, you have to be able to actually hold this though, because if you're going negative $250 roughly a week and you can't do it, well, then it's not a good strategy for you.
Yeah.
But if you can actually hold, there's that real potential there.
Exactly.
And this is what's really coming from the confidence. And the whole point of this episode today is that confidence that's actually potentially going to be entering back into the market now, that especially in some markets like Melbourne, like you were using with the Logan reference before as a comparison, just haven't been seeing a hell of a lot of confidence from the general public.
Yep, that's it. So before we wrap this up, Todd, I just want to talk about opportunity cost. So we talked a lot about cash flow. That's really important. Now, hypothetically, imagine rates do not change at all for a year.
Okay.
So holding cost is about negative 10 grand.
Yep.
But what would happen if you still could hold that, but say the property's gone up 50K?
Okay, so you're looking at this going like it's more of like a cost of doing business. 10 grand negative is not ideal.
Yeah.
However, if you're getting that capital appreciation, you're still up 40K.
Exactly, yeah. And that's the big picture. Like, we're not here to make massive like cash flow lifestyle changes. It's riding the wave up to increase our capital base.
And it is always the thing that you've got to balance. Like it's cash flow and capital growth. Like I never understood that argument about cash flow versus capital growth. It's like saying like feet versus hands. Like I'd like both of them. Like they're both pretty important for different reasons. And I think it's the same thing with building a portfolio. Yeah. And so you're basically looking at this going, even if you've got some negative cash flow for a little bit, if you're buying an area that feels like it is actually set for some growth, whether it's now or whether you're a real early adopter and you're waiting a little bit for the market to pick up, or maybe you're forcing some equity uplift, whether it's subdivision, reno, whatever, then your negative cash flow is just kind of that like cost of doing business.
Yeah, definitely. Like you're not going to be able to quit your job on just residential income unless you do some crazy things with time. But we're basically holding on to ride the property wave up and watch our residential portfolio grow in value.
Or fix your flux capacitor.
That's it.
Is that what it's called?
Yeah, that's it, DeLorean. Yeah.
Okay, yeah. All right, wrapping this up, man, I want to talk about borrowing power because this is the thing that I think is going to get a lot of people excited. We're talking a full 1% reduction in interest rates, like in the cash rate, which let's assume the banks are all passing on, okay?
Yep.
What is that actually meaning as far as borrowing power is concerned?
Yeah, so look, I'll give you two scenarios. We'll look at two different banks here. So at the time of recording this, ANZ, so we're looking at 6.12% rate. Obviously, this is going to change after we've recorded. However, with that rate, currently, you can get a loan of $637,000.
$637,000. Okay, and what happens if we're coming down a 4%?
So if you come down a full 1%, then you're looking at a borrowing capacity of 680.
All right, 637, 680. Like it's a bit. Honestly, I was expecting a little bit more.
True, yeah. But I mean, look, Todd, that's not it. Like there's actually one more scenario we need to unpack.
Okay, what's this?
So it may sound a bit crazy, but if we're going to say a second tier lender, so somebody like First Mac, for example, so the exact same scenario from before.
So the 85K single, yeah.
Yep. So you can initially get a loan of 723.
What, like now?
Right now.
It's already better than the rate drop one for that. Okay, so how much did you say? 723?
723 right now.
723. Okay, yeah. And what happens after 1%?
So it will then jump up to 781%. Sorry. I'll say that again.
That'd be horrendous.
Holy shit.
Instant bankruptcy.
Okay, so actually what I mean is $781,000 loan.
That makes a lot more sense.
Yeah.
Okay, so $781,000. So that's huge. Okay, so already what is that then? That we're talking a similar kind of increase, but if we're going to like a second tier lender, is the rate wildly different? Like is that like 2% extra or anything crazy or?
So yeah, Todd, like with second tier banks, the rate will be a touch bit higher, but the trade-off with this is that you're in a completely different league now. You can buy better quality assets now instead of waiting for rates to drop and then potentially missing out altogether.
And we're talking about someone on 85K. We're not talking about like, someone that's on 150 or a household that's on 200-300.
Exactly.
Wow. So there's big differences. All right. So in summary, opportunity cost, look around the corner. There might be a little bit of negative cash flow now, but rates keep going in this kind of direction. Things are potentially going to even out. We're looking at more potential rental increases, and this like potential $200-300 a week negative can then start turning into neutral or even positive in some cases. And then if we're looking at a full % reduction, like in that comparison, it's not just about the cash flow side of things. Borrowing power is what's really shooting up as far as a first tier or second tier, but definitely with the second tier. But again, this is something that you absolutely want to make sure is actually right for you in your situation. Don't just go debt yourself to the eyeballs just because it sounds good that you've got more properties. It needs to actually fit your goal and your cash flow. But Morgan Bushell, thank you so much for jumping on the show, mate. It's always a pleasure having you on.
Thanks, Todd. Cheers.